Thank you for tuning in. Welcome to the video. So I'm going to show you how to trade the three drives pattern. So this is a very nice pattern in price to trade. When it occurs, price is telling you that it has reached the end of its move, basically, whether it's a bullish or a bearish move. So you wait for price to create three consecutive highs or lows. So you basically wait for price to take out either buy side liquidity three times or sell side liquidity consecutively three times. Then you wait for a market structure shift. So when price trades to the opposite end of a swing high or low with displacement, that's a market structure shift. So if price is taking out sell side liquidity, and then after taking out sell side liquidity, it raids the short-term high formed with displacement, that's a bullish market structure shift. So you wait for a market structure shift, and then you enter at the fair value gap, and you aim for liquidity. So in the previous example I just mentioned now, if price now takes out the swing high with displacement, that's a bullish market structure shift. So now you're aiming for buy side liquidity. So I'm looking at the Nasdaq futures contract. I'm on the regular trading hours. So we open at 9:30. We open at 9:30. Then we create a low here at 10 o'clock. We have a swing high here. So price rates the swing high after collecting liquidity. So now that's a bullish market structure shift. That's a bullish market structure shift. It's telling us that price is in a buy program. Fair value gap, silver bullet fair value gap. Price creates the high here, the short-term high, and trades to this fair value gap. And then we raid this high. So we have a high here that got taken out. Market trades back to this little pocket of imbalance here, fair value gap, finds support there, short-term high, we raid through the short-term high. So now we've taken buy-side liquidity how many times? We took it for the first time here, we took it for the second time here. How many highs do we have in price? We have 1, 2, 3 highs, 3 consecutive highs in price. So hence the name three drives pattern. When we see that third high being formed here, price does not have to take out buy side liquidity here. What I just said with you right now is gold. It's one of those things that when I hear ICT mentions them, I write them down, and then that process of taking notes, it fast tracked my learning. 1, 2, 3 highs. As soon as you see the third high being formed, price does not have to take out liquidity. Now, you wait for 3 consecutive highs to be formed. That's the number 1 rule. Number 2, you wait for a market structure shift. So we have a swing low here. This low has a lower low to the left and a lower low to the right. This candle here, that's a swing low. So as soon as that is taken out impulsively with displacement and there's a fair value gap, that's a market structure shift. So you wait for a market structure shift. So in this example, that's a bearish market structure shift. That's a bearish market structure shift. In other words, price is confirming that it's in a sell program. So you will see we see price taking out this swing low impulsively. There is a fair value gap here. Let me denote it. We have a fair value gap here, and then we also have a volume imbalance. So we see price trading back to the volume imbalance and then breaking low. So when you're trading the drives pattern, you can sell at the volume imbalance. But let's say you are still new to this concept and you're waiting for the fair value gap and you miss that. That does not mean that you missed your trade. Right? And remember, that's because you don't know what a volume imbalance is or you're not yet aware of it. That does not mean that price will not create the trade drives pattern and then trade back to the volume imbalance so that smart money can sell. Right? So you, in the rules, I say wait for a fair value gap, but this is also a gap in price. It's not a fair value gap; it's a volume imbalance. But you can also sell that. Right? You can also sell that and you target liquidity. So let me just get my stop loss there. Price does not need to trade above the candle that created the imbalance. Then you obviously aiming for you can aim for this fair value gap as like a low hanging fruit. You just aim for the fair value gap. Nice 1:2. It's great. If you wanna aim for the order block, you can aim for it as well. If you wanna aim for the rejection block, you can aim for it as well. If you wanna aim for the coin square encouragement, in other words, the midpoint of this week, the midpoint of the week here is the coin square encouragement. So as you can see, price trades to it perfectly here. But if you're aiming for buy side, sell side, in other words, if you wanted this low to be rated, unfortunately it does not take out this low, at least in the New York AM session. Let's say it happens that you miss the entry. Well, after price trades to the volume imbalance, it breaks lower. Order block. That's a bearish order block. So that's a bearish order block. You could sell that. You could sell that and put your stop loss above the mean threshold. Or just put the stop loss above the order block basically. Because if I say mean threshold, it's gonna have too much of a tight stop loss that you might end up getting taken out because of spread. So just put the stop loss above the order block. Oh yeah, you have to put price above the order block. Why? Because we have the opening price of the order block, the middle of it is the mean threshold, then the closing price. We don't expect price to trade to that. So you can put your stop loss there. But like I say, you don't want to get taken up with a spread, so rather put it up there. Then you show if price takes as your stop loss. So for this trade idea, you would have been wrong. And that's completely fine. Again, you can target the fair value gap there, or all the other PDRAs that I mentioned earlier. Let's say you missed that order block entry. Well, there's a fair value gap here. Price goes above it to trade to the order block. it then breaks lower, and then fair value gaps have a very sensitive price at the midpoint. So I'm gonna mark the midpoint of the fair value gap, which is the consequent encouragement. Price trades to it here perfectly, and you can sell that as well. Your stop loss, you put it above the candle that created the fair value gap. So this one, stop loss right there. Take profit still the same. So the more the market goes down, it creates more PDR rates for you to sell. You can sell them. Fair value gap here, I think that's the last premium array that price trades to. You could also sell that. You get the point. So that's how you trade the trade drives pattern, guys. Thank you for watching. Please like and subscribe.